Hi, this is Peter Leahy. I'm here to talk about the basis trade, long basis trade between US Treasury note futures and United States Treasury notes, so-called cash. This is not a new type of transaction. However, there have been quite a few initiatives and regulatory changes in the last year or so, and some which are still coming. Today we're in June 2026. So we're somewhat in the midst of some changes that are happening to this kind of transaction because of changes that are happening in the United States Treasury cash and futures markets. So Treasury note cash futures basis trading has become a really very large element of what goes on in these markets. So large, in fact, that it has become something of a systemic worry for regulators, i.e. it's become so large that regulators worry that it could become a danger to the system if anything went badly wrong with it. There have been a couple of incidents where hedge funds have had to liquidate basis trades in a hurry, mostly due to spikes in the repo market, which they use to finance the cash leg of these transactions. So just what we're going to be talking about: the futures contracts themselves, some of the delivery calculations. This is what lies behind how these transactions work. So-called cash and carry trades. This is where the arbitrager buys cash treasury notes and simultaneously shorts futures, one being overpriced or relatively overpriced to the other, which is apparently cheaper. Thus the source of what is loosely called an arbitrage. We'll see that this isn't strictly an arbitrage. There are things that can go wrong. Arbitrage, of course, means where you get a risk-free profit. This has some residual risk to it right up until the trades are closed. We'll be talking about the idea of cheapest to deliver. We'll be talking about the basis trades themselves and some of the regulatory changes that are coming and the impact of those. There are active contracts in the US Treasury market, 2, 5, 10 and 30-year contracts. All of these, or at least at the professional level, there are some micro contracts which are directed at retail operators that are not physical delivery. All of the ones that we're going to be talking about here are physical delivery. We're also aware that there are ultra contracts that have a narrower basket of deliverables. These do have a bearing on what we're talking about, but most especially they have a bearing on the long bond futures. And actually, most of what happens in what we're here to talk about, the basis trades we're talking about, is in what you might call notes, so twos, particularly 2s, 5s, and 10s. So the ultra contracts are not going to be a big feature of our discussion here. All of these contracts then allow for physical delivery. They have a defined basket of, for example, 8.5 to 10 years for the 10-year contract. And they allow for the delivery of different bonds which have been issued at different times and therefore have quite different coupons, maturity dates, and durations. We convert each of these bonds to be deliverable into the futures contract. Well, we don't convert them, but we convert a price for the futures contract using what's called a conversion factor for each deliverable bond. And it's the calculation of conversion factors which is one of the things that causes distortions in this market. So conversion factors, these futures contracts, each of them, or each of the ones that we're here to talk about, have a notional coupon rate of 6%, which means that in theory, if yields for that segment of the market, such as the 2-year, were around 6%, you'd expect the futures contract to be about par, and the conversion factors then would be useful numbers for converting that par price futures contract into a clean price for each of those deliverable bonds, which could be at a premium price or a discount price, depending on its static features, most especially its coupon and maturity date. Okay, so we've put that here, this idea of a 6% notional, and the use of the conversion factors, more of which we'll see in a moment. The conversion factors you can think of then as being a clean price for any of the deliverable bonds, a clean price per $1 face amount at which it would give you a yield of 6%. And you can imagine then that these are quite varied numbers depending upon, once again, the coupon and maturity date. These cause a distortion because they're based upon, when you think about it, a snapshot of the relative prices, how they would stand relative to each other for the various deliverable bonds at a yield of 6%. Now, if yields have moved away from 6%, which very substantially they have, then the prices are all actually higher than that. But importantly, some of the prices will have moved by relatively more than others. Some of the bonds, right now, yields for most of these kind of bonds are around or just above 4%. The notional coupon for the contracts, as we've seen, is 6%. So that's a 2% shift in yields. The prices of these bonds will not all have shifted by the same sort of quantity. Some of them will have higher durations, most particularly modified durations, than others. And that is one of the things that gives us distortions in the deliverability or rather the choice of what to deliver against these contracts. It's what makes one of the deliverable bonds the so-called cheapest to deliver, and others of them are less optimal, even quite punitive to deliver. Okay. So, point I've made, some will have changed by more than others. And I've just put in here a little investigation of this. I've taken 3 deliverable bonds that we'll call blue, red, and yellow. And I've calculated what the price would have been at around a 6% yield. And in fact, the blue bond has a coupon of 6%, so no surprise that its price at a yield of 6 was calculated to be almost exactly par. I've made this accurate and precise using days and so on, so it's not exactly par shown there. Don't worry about that. The red bond had a lower coupon, and the yellow bond lower still yet, 2% coupon. And you can see the percentage price change from where they started to a yield of 4% is shown at the bottom. And you can see then that the blue bond will have moved by least, and the red and yellow bonds having higher durations will have moved by more. So, if you calculate a delivery price based on how they stood relative to each other at a yield of 6%, you would be rather understating the price of the yellow bond. You wouldn't be doing anything particularly unfair to the price of the blue bond, but for the red and yellow bonds, you'd be understating those. This is what I've shown here with a bit of a sort of a color diagram for those of you, including myself, who like that kind of thing. The diagram's always good. So all 3 bonds currently yield near 4%, which have higher prices than where they started, but the biggest proportional move, which is actually not as obvious as I'd like it to be from this diagram, the biggest proportional move has been the yellow bond, which actually numerically, you can see it there, 3.75%, not 3.5%. So you can imagine that this then gives biases to what we choose to deliver. The yellow bond, if we chose to deliver it, would be disadvantageous to ourselves, would be giving money away. And that's worth remembering for part of our discussion as we go a little bit further forward into this in the next 5 or 10 minutes or so. Any rational party looking to deliver one of these bonds using the conversion factors as discussed, you'd want to be delivering the blue bond. And the blue bond here is likely to be the so-called cheapest to deliver. We're going to focus mostly, as I said, on the long basis trade. We'll talk about this some more in a short while, but the long basis trade involves buying cash, treasury notes, and selling futures. It's important that if you think about that, when you sold futures, you have important optionality, which the long position in futures does not have. The sold party has a choice of what to deliver, and in fact, in the US market, precisely when in the relevant month to make that delivery. The long position in futures doesn't have that. So when we're doing a long basis trade, the long basis trader has a long position in cash treasury notes and a short position in futures. It makes a short basis trade a little bit more complicated and risky, because if we're short basis, then we're long futures and we don't have any control over what gets delivered to us, which could end up being a rather expensive mess. So here's the so-called cash and carry trade. The cash and carry trade is what determines the calculations here, or what is the cheapest to deliver, and how much can be made out of any of these bonds doing this kind of buy the bond, sell the futures transaction. Most of the transactions done in so-called basis trades are done by leveraged funds, and so not only do they buy the deliverable bond, not only do they sell the futures, but they are also going to do repos for the term from execution through to delivery to finance their purchase of the bond. And actually, we'll be comparing largely the so-called implied repo rate, which is the rate they earn on the cash they've invested into the cash and carry trade, and we compare that to the cost of financing that transaction, which will be the actual repo rate. And if they get an implied repo rate that is anything higher than the actual repo rate, then they have, frankly, the possibility of a gain. You could call it an arbitrage. They tend to be very small gains, small arbitrages, but these people will multiply that up, magnify it up quite substantially through leverage using the repo market. And by the way, as a little footnote there, that's one of the reasons why up till now, and this is all changing, the 2-year and 5-year have been a particular focus for these transactions, especially the 2-year, because for a lot of these funds, they've been able to negotiate zero haircuts, i.e. very low haircuts, initial margin of zero, to do these transactions, which of course the amount of haircut you're subject to in financing a trade like this will be an important determinant of how much money you can make out of it, or how much leverage you can have. That's what's one of the things that is changing, and we'll talk about the extent of that change and how important those changes are, or to an extent are not. We don't focus here much on short basis trades because of the uncertainty I described of not knowing what's going to get delivered to you. It is possible to do short basis trades because we'll talk about the closing out, the ending of basis trades. If you run these trades to delivery, then as a short basis trade you do have this problem of not knowing what's going to be delivered to you. But one of the things you could do is you could execute a short basis trade and plan to close it out prior to delivery, so that if you're short a bond, you're long the futures, but you have complete control over which bond, which bond you're short of, but you're not going to have to scramble around to change that bond or find something else at the last minute. So short basis trades are possible, but particularly viable if you consider the idea of closing out or rolling into the next quarterly contract prior to the expiry of the current contract. So here's a rather complicated picture. It's not as complicated as it first seems. So the basis trader is going in the cash market to buy a bond. They're using repo financing for that, and at the same time they are initiating a short position. So here in this grey box on the left, this one here, we're talking about the things that happen initially. So buying the cash bond, selling futures, lining up repo finance for that bond. And what we plan to do at a later point is exit the short position and deliver bonds. I've separated these two boxes because there are two possibilities here, and I've already somewhat alluded to this. One tidy and simple possibility is that the bond previously purchased gets delivered against the short position in futures, and when you deliver that bond against your short position in futures, that closes out both of those things. You've sold and been paid for the bonds, and you have executed a closing transaction that closes your futures position. An alternative, and we'll talk more about this in just a moment, is to not run to delivery, but to close out the transaction prior to that date, perhaps only a few days before the beginning of the delivery period. We'll talk about the pros and cons of that when we get to it. Here I've taken, a recent 2-year note, and I've just calculated a couple of things. This is really just the usual calculation for a bond, the semi-annual actual 360 periods, the cash flows for this 4% coupon 2-year note, and the present value factors and the PVs. They've allowed me to calculate the dirty price. I've calculated the accrued interest, and the clean price is shown here. What I've also calculated is if we were to short futures, given a conversion factor, given the futures price, and given an assumption of when we're going to deliver and when we bought, so this is from May 26 through to late September, or even into early October 26. This is the September 26 contract. Using a conversion factor, we've calculated an assumed delivery dirty price, and you can see what we paid as a dirty price originally and what we're getting later. And you can see then what we're earning from this transaction, which is about 3.676% shown there. I've shown then the actual repo rate, and this is not something then that is compelling, because what it costs to finance this trade is pretty much the same, only perhaps a whisker lower. If we leverage this up massively, we could make something out of that. The cost of financing this trade is only a tiny bit lower than what we earn from it, but it's shown there, and the purpose here is just to show the calculation. So the cheapest to deliver bond is the one where doing this calculation for all the bonds, we get the best return or the smallest loss. We can think of this return in one of two ways. In terms of the implied repo rate, what we're earning on the cash and carry trade minus what it costs to finance that total position. Or we can think of it in terms of the delivery proceeds of delivering, right, minus the forward price of the deliverable, that is to say, what it's cost us, all in with the repo finance subtracted from what we're getting paid to deliver that bond. Of course, that second method is only particularly useful for where we plan to have delivery. It's a slightly altered, not in any complicated way, but slightly altered calculation where we are going to close out prior to the delivery period. Okay. In a well-ordered world with everything priced the way they should be priced, there shouldn't really be an arbitrage here, because the futures sold position, as we've said, enjoys quite important optionality over what they deliver and when they deliver, and that optionality is to their benefit, and they should expect to pay for that optionality by suffering a slightly inferior delivery price. So in a world without any external factors influencing how these things are priced, we would expect there to be a negative return from the cash and carry trade in most cases. We'll see that is not quite the case. We've spoken about the optionality there. However, so what is it that gives us some kind of arbitrage here? And this has a lot to do with, actually to do with regulation. Banks have, since capital rules changes, Basel 3.5 or 4, whatever you call it, as well as other post-financial crisis changes, banks find it increasingly costly, let's put it that way, to hold on to Treasury securities. You know, we all know, we hardly a week goes by without reading something about the diminished liquidity in the US Treasury market, and this is part of why banks really are much less willing to hold inventory of bond securities, even Treasury securities, compared to how things were before. There is not a convenience yield for holding physical treasuries. There is an inconvenience yield because of the cost, the burden they carry from holding them. Secondly, there's been huge growth in index funds, and not least there's been a huge growth in fixed income ETFs, and these largely track indices such as on credit, such as the Barclays indices, such like. Now, if you're structuring such a thing, you will often find that the elements you put in place are actually have ultimately, or you find them to have a lower duration than the index. And for many of the managers of such funds and investment funds and tracking funds, they find they need to access something to increase the duration to match the duration of the index that they're seeking to match. And given relatively shorter duration credit assets, they find that they need to add on something that brings duration on top of that without costly investment. And an easy way to do that then for them is to buy into Treasury note futures to top up their duration. So they are buyers of Treasury note futures, and this is quite, it turns out to be substantially influential, resulting that in fact relatively illiquid off-the-run Treasury notes can be bought at prices that allow a net profit on a long basis cash and carry trade. We find this happens quite a lot. It must be happening because these trades are being done in very large size. I've spoken about this a little bit, and I'm not going to dwell too greatly on this. I'm aware of the time we're taking. So some of these trades get closed out by delivery. That's a kind of time and effort inefficient. Much better, perhaps, if you've found good, cheap assets to base these trades on. Much better if you can roll the futures forward, roll March into June, roll June into September, and keep going, and so forth. That relies, of course, upon quite skillful ability to roll the contracts. Or a third means is to close out early. Usually, people only close out early. That is to say, liquidate the positions without rolling into future months. And the only real reason to do that is that something has gone wrong, such as increase in margin, some kind of spike repo cost, withdrawal of leverage, and so forth. So, one of the things I'll say about the delivery process and closing out on the delivery process is you can keep these trades quite simple. These tend to be match notional. So if you're doing these with the CTD, and you'd be well advised to do these with the CTD because otherwise there are complexities you don't want. If you have matched notional and the CTD, you'll find that the futures price converted by the conversion factor has about the same DV01 as the cheapest to delivers DV01. That is actually how the futures contract derives or gets its DV01. It is from that link to a particular bond which is cheapest to deliver. So the beauty here is we don't have to do complicated management of DV01. We just do notional for notional, and that keeps it quite simple. If we are prepared to roll over prior to delivery, i.e. not run the contracts to their delivery date, then slightly different things apply, and we can allow ourselves to have a slightly more sophisticated trade. We can manage the DV01 to exactly 0 by the exact choice of how much or how little we buy of the deliverable. So this strategy then is where we're seeking to run these basis trades into the medium term and run them with a DV01 as close to 0 as possible. There is a risk here in terms of the roll from March to June, June to September and so forth, but that is part of the skill of the manager and effectively their broker. I'm not going to say much about this. The closing out of futures and cash positions early, mostly, as I said, this is in response to adverse circumstances, so not usually something that we plan for or contemplate in advance. One of the things about these trades, often the long basis trades are based around non-CTD trades. Now, trading a long basis trade based on a non-CTD, you found some off-the-run security in a relatively illiquid time in the Treasury market, and you've bought those and you're executing a long basis trade against those, and you plan to roll. In fact, I'm going to say to you, you must roll, because if you don't roll, then going into the physical delivery cycle and planning to deliver a non-CTD security, you are throwing a penalty at yourself. It's going to have a needless cost. And so you avoid that. You plan to roll these trades, and you plan to keep them to a DV01, as I said, around 0. Now, one of the things that is happening now is we're seeing initial margin applied to nearly everything. As I've said earlier in this piece, we have had in the past the possibility of some of these funds accessing leveraged finance on a 0 haircut in the context, for example, of 2-year notes. That's really not going to happen anymore. This is becoming mandatory. Non-zero haircuts, minimum haircuts, initial margins. There's been a lot of talk about that reducing the economics of basis trades to the point of non-viability. We'll see about that. However, and the big however here is that we have had initial margin or haircuts introduced, but if you've now got a financed long position in Treasury notes and you've got a cleared, obviously, short position in the futures, all it's taken actually is a conversation, the creation of a kind of institutional communication between these two organizations, CME and FICC, to allow for cross-margining, whereby there's a saving. And so I put this here. Here I've taken a long 500 million 10-year notes and a short position in the equivalent amount of 10-year futures contracts. This is just to illustrate this idea of cross-margining and the saving from it. So in the current bilateral scenario, there would be an upfront requirement. Let's say, I'm keeping this simple, 10% upfront margin of 10 million, right? The repo leg would suffer nothing at all, and there'd be no cross-margining offset. And so a 50 to 1 leverage, 50th there, forgive me, I should have said. And here you've got what might happen next, scenario A, where we now get initial margin imposed on both of these things. The futures leg still the same, but also a substantial haircut on the cash repo leg. And in the simplest case, those get added together and your available leverage is cut more than in half. I've then shown what if we have actually now cross margining, a recognition between these two organizations that one has got a positive DVO1, the other position's got a negative DVO1, so that should be considered and allowed for as a considerable risk offset. And that is where we're going. And you can see here, potentially the total margin required is then reduced down to, for example, 5 million. And that takes us back to something more like 100 to 1 leverage. That's about all I wanted to say. Please have a look at our content on Udemy. There's quite a lot on there. And I'll look forward to the next time. Thank you.